Before we dive into today's critical analysis, I want to invite you to join our community of thoughtful investors. If you value disciplined financial insights delivered without sensationalism, please consider subscribing to our channel. Subscribe button. We're committed to providing you with the clear, rational perspective you need to navigate complex market conditions. Now, let's examine what some economists are calling the most significant financial challenge in half a century. We stand at a unique intersection in financial history. Leading economists are issuing warnings that echo the gravity of past crises, yet the landscape we face today presents complexities that previous generations never encountered. The convergence of unprecedented monetary policy, shifting global power structures, and demographic transitions has created what many experts believe could be the most challenging financial environment since the 1970s stagflation crisis. This isn't about predicting market crashes or timing perfect entries and exits. This is about understanding the fundamental forces reshaping our economic reality and preparing accordingly. Today, we'll examine these forces through the lens of rational analysis. We'll explore what history teaches us, what current data reveals, and most importantly, how you can position yourself to navigate whatever lies ahead. To grasp the magnitude of current warnings, we must first understand what constitutes a genuine financial crisis. The past 50 years have delivered several defining moments that reshaped markets and investor behavior. The 1970s brought stagflation, a toxic combination of high inflation and economic stagnation that confounded traditional economic models. Interest rates soared above 15%, while unemployment remained stubbornly high. This period fundamentally changed how central banks approach monetary policy. The 1980s debt crisis saw Latin American countries default on massive obligations, threatening the global banking system. The savings and loan crisis followed, wiping out hundreds of financial institutions across America. The 1990s introduced us to asset bubbles on a new scale. The Japanese real estate and stock market collapse created a lost decade of economic stagnation. Meanwhile, the dot-com bubble demonstrated how technological optimism could drive valuations to unsustainable levels. The 2008 financial crisis revealed the interconnectedness of global markets and the systemic risks posed by complex financial instruments. Central bank responses to this crisis fundamentally altered the investment landscape for the following decade. Each crisis taught valuable lessons about market psychology, systemic risk, and the importance of preparation. Yet the current environment presents challenges that combine elements from all these previous crises while introducing entirely new variables. What makes today's situation particularly concerning is the convergence of multiple risk factors that rarely align simultaneously. We're witnessing the unwinding of the most aggressive monetary experiment in modern history. For over a decade, central banks maintained interest rates near zero while purchasing trillions in government and corporate bonds. This unprecedented liquidity injection distorted traditional market pricing mechanisms and asset valuations. The pandemic accelerated these trends dramatically. Governments worldwide implemented fiscal stimulus programs that dwarfed previous crisis responses. The resulting surge in money supply occurred simultaneously with supply chain disruptions and changing consumer behavior patterns. Inflation returned with a vengeance, reaching levels not seen in 4 decades. Central banks faced the difficult task of combating inflation without triggering a severe recession. This balancing act has proven more challenging than many anticipated. Geopolitical tensions have added another layer of complexity. Trade relationships established over decades face increasing strain. Energy security concerns have resurfaced. The global financial system's stability depends increasingly on the coordination of major powers who find themselves in growing competition. Demographic shifts present long-term challenges that extend beyond typical business cycles. Aging populations in developed countries strain pension systems while reducing the working-age population's growth rate. These trends have profound implications for economic growth and government finances. Understanding market cycles requires recognizing that financial markets operate on both rational and emotional levels. While fundamental analysis provides valuable insights, investor psychology often drives short-term price movements more than underlying economic data. The current cycle presents unique psychological challenges. Many investors have only experienced rising markets supported by accommodative monetary policy. This generational experience gap creates potential vulnerabilities when market conditions change dramatically. Fear and greed remain the primary emotional drivers of market behavior. During periods of uncertainty, these emotions become amplified. Investors who understand their own psychological tendencies and prepare for emotional challenges perform better during volatile periods. Market cycles typically follow recognizable patterns, though the timing and magnitude vary significantly. The current environment suggests we may be transitioning from a period of artificial stability maintained by central bank intervention to a more natural market discovery process. This transition often creates volatility as markets recalibrate asset prices based on new economic realities. Investors who recognize these transitions and adjust their strategies accordingly often emerge stronger from periods of market stress. The key lies in understanding that volatility represents opportunity for prepared investors while posing significant risks for those caught unprepared. Preparation involves both financial positioning and psychological readiness for challenging periods. Several macroeconomic trends are converging to create the current challenging environment. Understanding these forces helps investors make more informed decisions about long-term positioning. Monetary policy normalization represents perhaps the most significant immediate challenge. After years of ultra-low interest rates, central banks face pressure to raise rates to combat inflation while supporting economic growth. This delicate balance rarely proceeds smoothly. Fiscal policy constraints limit governments' ability to respond to future crises as aggressively as in the past. Debt-to-GDP ratios in major economies have reached levels that raise questions about long-term sustainability. Global trade patterns continue evolving as countries prioritize supply chain security over pure cost efficiency. This trend toward regionalization may reduce some systemic risks while potentially increasing costs and reducing innovation. Technological disruption accelerates across multiple sectors simultaneously. While innovation drives long-term economic growth, the transition periods often create winners and losers that reshape entire industries. Climate change considerations increasingly influence policy decisions and investment flows. The transition to sustainable energy systems represents both significant opportunities and substantial transition costs. These forces interact in complex ways that make precise predictions impossible. However, understanding their general direction helps investors position portfolios to benefit from long-term trends while protecting against transition risks. Several indicators suggest that market conditions may be more fragile than surface-level performance suggests. These warning signs don't guarantee immediate crisis, but they warrant serious consideration in investment planning. Valuation metrics across multiple asset classes remain elevated by historical standards. While low interest rates justify higher valuations to some degree, the rapid pace of monetary tightening raises questions about current pricing sustainability. Credit markets show signs of stress as borrowing costs rise and lending standards tighten. Corporate debt levels remain high by historical standards, making many companies vulnerable to economic slowdowns or refinancing challenges. Real estate markets in many regions display characteristics reminiscent of previous bubble periods. Rapid price appreciation, speculation-driven buying, and stretched affordability suggest potential correction risks. Currency markets reflect growing tensions between major economic powers. Currency volatility often precedes or accompanies broader financial instability, particularly in emerging markets with significant foreign currency debt. Commodity markets exhibit extreme volatility as supply chain disruptions interact with changing demand patterns. Food and energy price instability can trigger social unrest and economic disruption, particularly in developing nations. The interconnectedness of global financial markets means that stress in one area often spreads quickly to others. This systemic connectivity amplifies both positive and negative market movements. While every financial crisis develops unique characteristics, historical patterns provide valuable insights for understanding potential future developments and appropriate responses. The 1970s stagflation period offers perhaps the most relevant comparison to current conditions. Like today, that era featured high inflation, geopolitical tensions, and energy supply disruptions. The eventual solution required sustained high interest rates and significant economic pain. The Japanese experience in the 1990s demonstrates how asset bubbles can deflate slowly over extended periods rather than crashing dramatically. This lost decade scenario represents an alternative to sharp crisis resolution that many developed economies may face. The 2008 financial crisis highlighted the importance of systemic risk management and the speed with which confidence can evaporate in interconnected markets. The recovery from that crisis required unprecedented coordination among global policymakers. Emerging market crises throughout the 1990s and 2000s illustrate how external debt, currency mismatches, and political instability can interact to create severe economic disruption. These patterns remain relevant for understanding current global vulnerabilities. The Great Depression provides lessons about the importance of maintaining financial system stability and avoiding deflationary spirals. Modern policymakers' understanding of these risks has improved significantly, but the tools available for response may be more limited today. Each historical example reinforces the importance of preparation, diversification, and maintaining long-term perspective during periods of market stress. If you currently hold significant assets, your primary focus should be preservation and positioning for potential volatility. This requires a different mindset than growth-focused strategies that worked well during the low-rate environment of the past decade. Portfolio diversification becomes critical during uncertain periods. This means looking beyond traditional stock and bond allocations to include assets that perform well during inflationary periods or market stress. Real assets, international diversification, and cash positions all deserve consideration. Quality focus should guide security selection. Companies with strong balance sheets, consistent cash flows, and pricing power tend to outperform during challenging economic conditions. Avoid highly leveraged companies or those dependent on cheap financing for growth. Risk management takes precedence over return maximization. This might mean accepting lower potential returns in exchange for reduced downside risk. Position sizing becomes more important as volatility increases. Regular portfolio rebalancing helps maintain target allocations as market conditions change. During volatile periods, this disciplined approach often results in buying low and selling high, though it requires emotional discipline to execute consistently. Consider the tax implications of portfolio changes, particularly in taxable accounts. Market volatility can create tax loss harvesting opportunities, but timing these strategies requires careful planning. Liquidity management deserves special attention during uncertain periods. Ensure you have adequate cash reserves for both emergencies and potential investment opportunities that may arise during market dislocations. For those with capital-seeking investment opportunities, the current environment requires patience and strategic thinking. While market volatility creates risks, it also generates the potential for attractive long-term entry points. Dollar-cost averaging can be an effective strategy during volatile periods. Rather than trying to time market bottoms, systematic investing helps smooth out price fluctuations while building positions over time. Focus on fundamental value rather than momentum or technical factors. During market stress, prices often diverge significantly from intrinsic values, creating opportunities for patient investors willing to conduct thorough research. Maintain significant cash reserves for opportunistic investing. Market dislocations often create brief windows where quality assets trade at discounted prices. Having dry powder available allows you to capitalize on these opportunities. Consider defensive sectors and value-oriented investments. Utilities, consumer staples, and healthcare often provide more stability during economic uncertainty. Value stocks may outperform growth stocks if interest rates remain elevated. International diversification offers both risks and opportunities. While global interconnectedness means no market is completely isolated from crisis, different regions face varying challenges and opportunities. Build positions gradually rather than making large, concentrated bets. Market volatility can persist longer than expected, and gradual accumulation provides multiple entry points at different price levels. Understanding what not to do becomes as important as positive action during challenging market periods. Emotional decision-making destroys more wealth during market stress than external economic factors. Panic selling represents the most common and destructive mistake during market downturns. Fear-driven selling typically occurs near market bottoms, locking in losses just before recovery begins. Maintaining long-term perspective helps avoid this trap. Emotional trading based on daily news cycles rarely produces positive results. Market movements often reflect sentiment more than fundamental changes in underlying economic conditions. Developing the discipline to ignore short-term noise requires practice and preparation. Over-leveraging amplifies both gains and losses during volatile periods. What seems like conservative leverage during stable times can become dangerous when market conditions deteriorate rapidly. Stress test your leverage assumptions under adverse scenarios. Chasing performance or trying to time markets perfectly leads to buying high and selling low. Instead of attempting to predict short-term movements, focus on positioning for long-term trends and maintaining consistent investment discipline. Neglecting diversification in pursuit of higher returns concentrates risk unnecessarily. While concentrated positions can generate outsized returns during favorable periods, they also create vulnerability during market stress. Making major financial decisions based on fear or greed typically leads to poor outcomes. Develop predetermined decision-making frameworks that remove emotion from the equation during stressful periods. Following crowd behavior or popular investment themes without independent analysis often results in buying at peaks and selling at troughs. Contrarian thinking requires courage, but often produces superior long-term results. Effective risk management requires understanding both the probability and potential impact of various adverse scenarios. While precise prediction remains impossible, preparation for multiple outcomes enhances financial resilience. Position sizing should reflect both the probability of success and the potential magnitude of loss. Concentrating too much capital in any single investment or strategy creates unnecessary vulnerability to adverse outcomes. Hedging strategies can provide downside protection during volatile periods. These might include protective put options, inverse ETFs, or alternative investments that perform well during market stress. However, hedging comes with costs that must be weighed against benefits. Geographic and currency diversification helps reduce exposure to any single country's economic or political risks. While globalization has increased correlations during crisis periods, diversification still provides some protection. Sector and style diversification prevents overexposure to any particular market segment. Different sectors and investment styles perform differently during various economic conditions. Liquidity management ensures you can meet obligations and capitalize on opportunities during stress periods. This includes maintaining emergency funds and avoiding illiquid investments beyond your risk tolerance. Regular stress testing of your portfolio helps identify potential vulnerabilities before they become critical. Consider how your holdings might perform under various adverse scenarios, including inflation, deflation, recession, and currency devaluation. True financial resilience extends beyond portfolio management to encompass comprehensive financial planning and psychological preparation for various market environments. Emergency fund management becomes more critical during uncertain times. Traditional guidelines suggest 3 to 6 months of expenses, but current conditions may warrant larger cash reserves for some investors. Debt management takes on increased importance when economic conditions deteriorate. Reducing high-interest debt and avoiding new obligations that stretch your budget provides financial flexibility during challenging periods. Skill development and career diversification enhance human capital value. Economic disruption often creates both challenges and opportunities in the job market. Staying relevant and adaptable improves long-term financial security. Multiple income streams reduce dependence on any single source of financial support. This might include investment income, side businesses, or developing expertise in recession-resistant areas. Financial education provides the foundation for making informed decisions during complex market environments. Understanding basic economic principles and investment concepts enables more confident decision-making during stress periods. Building relationships with qualified financial professionals can provide valuable perspective during challenging times. However, ensure any advisors share your long-term orientation and conservative risk management approach. Understanding your own psychological responses to market volatility enables better decision-making during stressful periods. Most investment mistakes stem from emotional reactions rather than analytical failures. Fear and greed cycles drive much of the market's short-term behavior. Recognizing these patterns in both market sentiment and your own emotional responses helps maintain discipline during extreme periods.
Confirmation bias leads investors to seek information that supports their existing beliefs while ignoring contradictory evidence. Actively seeking diverse perspectives helps counteract this natural tendency. Recency bias causes overweighting of recent events in probability assessments. Just because markets have been relatively stable doesn't mean that stability will continue indefinitely. Loss aversion makes the pain of losses feel approximately twice as strong as the pleasure of equivalent gains. This psychological quirk often leads to holding losing positions too long while selling winners too early. Overconfidence in one's ability to predict market movements leads to excessive trading and inadequate diversification. Humility about market prediction abilities leads to better long-term outcomes. Developing emotional discipline requires practice during both calm and volatile periods. Create decision-making frameworks in advance to remove emotion from critical investment choices. Rather than betting on any single economic outcome, prudent planning involves positioning for multiple scenarios while maintaining flexibility to adapt as conditions evolve. Inflationary scenarios require different positioning than deflationary environments. Real assets, commodities, and inflation-protected securities perform differently than traditional stocks and bonds during persistent inflation. Recession scenarios typically favor defensive investments and cash positions. Quality companies with strong balance sheets often outperform during economic contractions. Stagflation combines the worst aspects of both inflation and recession. This challenging environment requires careful balance between inflation protection and recession defense. Currency devaluation scenarios affect international investments and domestic purchasing power. Understanding these dynamics helps inform geographic and currency allocation decisions. Technological disruption continues regardless of economic conditions. Positioning for long-term technological trends while protecting against transition risks requires careful analysis. Maintaining flexibility allows adaptation as scenarios develop. Avoid strategies that lock you into specific outcomes or prevent adjustment as new information becomes available. Understanding likely policy responses helps anticipate how various scenarios might unfold. While policy effectiveness varies, government and central bank actions significantly influence market outcomes. Monetary policy tools remain limited after years of unprecedented accommodation. Central banks have less ammunition for fighting future recessions than they possessed before 2008. Fiscal policy constraints limit governments' ability to respond aggressively to future crises. High debt levels and political polarization complicate rapid policy response. International policy coordination becomes more challenging as geopolitical tensions increase. The effectiveness of crisis response often depends on cooperation among major economic powers. Regulatory changes in response to current challenges may create new investment opportunities and risks. Financial regulation typically tightens after crises, affecting various market sectors differently. Understanding policy transmission mechanisms helps anticipate how government actions might affect different asset classes and market sectors. Political stability affects policy effectiveness and market confidence. Monitoring political developments provides insight into likely policy directions and implementation challenges. Developing a comprehensive action plan provides clarity during uncertain times and reduces the likelihood of emotional decision-making during market stress. Assess your current financial position honestly, including assets, liabilities, income, and expenses. Understanding your starting point enables better planning for various scenarios. Define your investment objectives clearly, distinguishing between needs and wants. This clarity helps prioritize decisions during challenging periods. Establish risk tolerance guidelines that reflect both your financial capacity and emotional ability to handle volatility. These guidelines should remain consistent regardless of current market conditions. Create specific decision-making triggers for portfolio adjustments. Predetermined criteria remove emotion from decisions about rebalancing, tax loss harvesting, or major allocation changes. Develop multiple contingency plans for different scenarios. Having thought through various possibilities in advance enables quicker, more confident responses when situations develop. Establish regular review and adjustment schedules. Markets and personal circumstances evolve, requiring periodic updates to your financial strategy. Document your rationale for major decisions to maintain consistency and learn from both successes and mistakes over time. The warnings from respected economists about potentially significant market challenges ahead deserve serious consideration. However, uncertainty represents the natural state of financial markets, not an aberration requiring panic or dramatic action. History teaches us that well-prepared investors can navigate even severe market disruptions successfully. The key lies in understanding the forces at work, maintaining appropriate risk management, and avoiding the emotional mistakes that destroy wealth during volatile periods. Rather than attempting to predict specific outcomes, focus on building resilience and positioning for multiple scenarios. This approach provides confidence regardless of how current uncertainties resolve. The current environment may indeed prove challenging, but it also creates opportunities for those who maintain discipline and long-term perspective. Markets reward patience and punish emotional decision-making, with remarkable consistency across different historical periods. Your financial future depends more on your responses to market conditions than on the conditions themselves. Building the knowledge, discipline, and preparation necessary for navigating uncertainty serves you well in any market environment. Take time to assess your current position, develop appropriate strategies, and maintain the emotional discipline necessary for successful long-term investing. The challenges ahead may be significant, but they are navigable with proper preparation and perspective. Remember that every market cycle eventually passes, but the habits and disciplines you develop during challenging periods serve you throughout your investment lifetime. Focus on what you can control, prepare thoroughly, and maintain confidence in your ability to adapt and succeed regardless of market conditions. The most successful investors throughout history have shared common traits: discipline, patience, proper risk management, and the wisdom to focus on long-term fundamentals rather than short-term market noise. These timeless principles remain your most valuable tools for navigating whatever challenges lie ahead. Thank you for your attention today. If this analysis provided value, please consider subscribing to our channel for more thoughtful financial insights delivered without sensationalism. Remember, successful investing requires discipline, preparation, and a long-term perspective, regardless of current market conditions.